Kia ora. Welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name's Patrick Spelly. I'm the editor at BusinessDesk, and today on Shared Lunch, we're going to look at the general election, what that means for investors like you, how the economy, and most importantly, how businesses might be affected. I'm joined in the studio today by Christina Leung, Principal Economist at the New Zealand Institute of Economic Research, and Chris DeLever, Director and Portfolio Manager at Harbour Asset Management. But before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Christina and Chris. Chris, I'll come to you first, just very high level, scene-setting questions about the share market as it is at the moment and as we head into the election. Do you think general elections, and this one in particular, actually make a difference?
Look, there's lots of analysis on this, and the short answer usually is no. But this time I think it could be a little bit different. And the reason for that is just that we've been through such extraordinary times over the past few years. And where we find ourselves right now as an economy is in an interesting position where we are slowing down. We're running deficits while we're slowing down. And that means the next government that's going to come in really has a big task on their hands. So I actually think this election comes at a really pivotal moment for New Zealand.
Why does that running a deficit during a slowdown make a difference? I'd have thought that was a fairly normal position to be in.
Yeah, but I suppose we are just seeing the early signs of a slowdown while we're still running deficits. So we don't, in my opinion, have the fiscal room should things get worse. So, as it stands today, we're running deficits through to 2027. What happens if we get another weather event? We tend to be having these 100-year floods every 1 to 2 years now. What if we get another macroeconomic shock? So that's kind of the reason that I think that the economy finds itself in quite an interesting position. And this next government, I actually think fiscal prudence is going to be really important going forward.
So just let me draw you out on that. So really what you're saying is that governments have very little room to move should anything else go wrong. Yeah. So what do you think that means at a high level for the investability of New Zealand companies? And does it make more difference in some areas than others?
So the key transmission kind of mechanism that I tend to think of with this kind of issue is more apparent in the bond and currency markets. So right now in New Zealand, our bond yields are really high relative to the rest of the developed world. And the more we kind of press things fiscally, the more we push out deficits, then probably the higher premium an offshore investor will demand to buy our bonds. And that is kind of relevant for the equity market as well, right? Because if you're an equity market investor, you can get a dividend yield of, say, 5% buying one of the gentailers, Mercury, Meridian, Contact, and the like. That dividend yield looks less attractive if you can get kind of a risk-free return out of a bond. It's also apparent in our currency market as well. So this is really relevant for people who are investing offshore. If offshore investors ascribe a larger sovereign risk to New Zealand, it probably, all things remaining the same, means a weaker currency. I think if we look today, we've actually seen that play out a little bit already. We've seen weakness in China, and that has led to a weakening New Zealand dollar over the past few months or so. So that's why this next government and a kind of credible fiscal plan is going to be so important.
Christina, we've just seen the quarterly survey of business opinion out this morning for the presumably September quarter. How much of what that is showing reflects anything that Chris has just talked about?
Yeah, so what we saw this morning with this in the September quarter is that firstly there's a further improvement in confidence amongst businesses, but more to the extent that fewer proportion of businesses are feeling downbeat about general economic conditions. Certainly when you look at that own trading activity measure of how firms are faring when it comes to demand in their own business, and there's still a net proportion that are indicating that there was reduced activity in their own business. So what that goes to show is that businesses are feeling cautiously optimistic about conditions ahead, but generally the mood is still pretty pessimistic. However, the caveat to that is that over the history of our survey, you do tend to see that ahead of general elections, confidence tends to be a little bit weaker, just with the fact that with the uncertainty over the outcome of the general election, businesses tend to hold off on committing to things, and this is reflected in investment intentions, both for buildings and also plant and machinery.
It's not uncommon, though, to see own expectations of your own business being stronger than firms' belief about general economic conditions. Is that still the case, or are people a bit more pessimistic about their own?
Yeah, there have definitely been instances when there's a divergence. What we're seeing at the moment is that demand, its activity is soft, but businesses, while they're feeling downbeat, less so relative to what we've seen, say, over the past year. So I would say it's turning around in terms of that pessimism. So businesses starting to feel a little bit better, but still a pessimistic read there.
How much of that, if any of it, do you think could be about the fact that when you look at the polls, it's very difficult to see that there's not going to be a change to a national-led government? I mean, how much does history tell us about how businesses feel about the future if they think they've got a blue government rather than a red government?
So I get this question all the time in terms of the impact on business confidence. And what I tend to say, is I pull out over the history of the survey, I could pull out the headline confidence measure, and you could pretty much pick out when the periods were when a national-led government took office versus when a Labour-led government took office, meaning that after when a national-led government takes office, you do tend to see a pickup in confidence. However, if I was to bring out a chart over the history of the survey of firms' own trading activity, which measures the actual demand that they're seeing in their own business, it's a lot harder to pick out the different periods when a national-led government was in place versus when a Labour-led government is in place. So the thing to take from that is that generally the impact of which colour government we get is more on confidence itself rather than actual activity.
Yeah, because one of the things that struck me about the QSBO when I read it this morning was that, just thinking in terms of listed companies and the next round of results, high cost pressures, reduced capacity to pass on costs or to increase prices. So to me that says, while they may be feeling a little more optimistic, there's not much there to suggest that they're going to be a lot more profitable.
So, some of the key take-ups from today's release is the fact that, first and foremost, we've seen a continued sharp turnaround in labour shortages, that easing in labour shortages, the fact that, particularly when it comes to unskilled labour, a net proportion of businesses now are reporting that it's easy to find unskilled labour. Rewind back to a year ago, where over half of businesses were reporting difficulty in finding unskilled labour, and similar in terms of that sharp turnaround in terms of labour shortages for skilled labour as well. We would say that the strong recovery we've seen in net migration has helped to, with that increase in labour supply, that's helped to alleviate labour shortages. So certainly there has been that easing when it comes to those capacity pressures in the economy. But as you were saying as well, we are seeing signs that that impact of higher interest rates in terms of dampening demand are starting to gain traction in the New Zealand economy with that softer demand. And while right now businesses are still saying that cost pressures are still fairly intense while easing a little bit, overall, that soft demand environment is making it difficult for businesses to pass on high costs to customers by raising prices. So it is a bit of a perfect storm there for businesses at the moment.
I want to come to you in a moment, Chris, and just ask about what the impact of those trading conditions is likely to mean for a range of NZX-listed companies. But I just wanted to check in with you, Christina. Have you seen circumstances in the past where things are quite so whippy in the sense that it feels to me, as you say, 12 months ago, less than 12 months ago, labour shortages would have been the biggest, and wage pressure would have been the biggest problem that business faced. It feels as if that's changing at an enormous rate of knots at the moment.
Yeah, so if you were to ask me when things were, last time things were this volatile, I would say the COVID-19 pandemic, naturally, just because it was such a massive shock to the economy, to the country. And
those are very unusual circumstances,
That's
whereas
right.
this is more like a cycle of some sort.
And now what we're seeing is that unwinding of a lot of those impacts. With the COVID-19 pandemic, what we saw was that labour shortages became very severe, and finding labour became the primary concern for businesses. Now we're seeing that shift away with those that being unwound, with that decline in proportion of businesses saying that finding labour is a primary concern. And in contrast to that, now businesses are reporting that lack of demand is increasingly becoming the key concern for them. So I would say it's not so much, it's more you're seeing the unwinding of what you saw in terms of the impacts, the very severe impacts of COVID-19 and the response in terms of that slashing of interest rates, both here and around the world, now being unwound, those impacts being unwound now.
So in these sorts of market circumstances, I mean, I think you've already made the point that interest rates are sufficiently attractive that in many ways an equity investor is going to be tempted to go the safe route. But there are always going to be sweet spots, and there are always going to be some who do better than others. When you look across the available investable equities in the New Zealand market, which sectors do you think are particularly exposed, and which sectors might actually be in a surprisingly good spot? I mean, it's not always bad news to be in
it's not. And we've got a kind of funny old market here. If you look at the New Zealand market, it isn't a reflection of our economy at all. You look at the 10 largest companies in New Zealand. Just look at the largest ones right at the top. Fisher & Paykel Healthcare. Kiwi company, great Kiwi name, not really a cyclical name, right? What's going on in the New Zealand economy isn't really going to impact Fisher & Paykel Healthcare. The most Kiwi that company is the fact that it reports in New Zealand dollars and has to translate all the US dollars to Kiwi. Right now, though, we are quite wary of the few cyclical names that do exist in the New Zealand market. And kind of key reason for that is kind of touching on what Christina said about the consumer. The consumer's having a tough time, and there's figures out there that we can calculate that say it's not going to improve anytime soon. And specifically what I'm referring to is the average outstanding mortgage rate in New Zealand, a bit over 5% on our numbers. Now, you go to the bank today and try and get a mortgage rate for 5%, you're not getting it. So you're rolling at higher levels like 7 and 8%. So that just means the average outstanding mortgage rate, barring something spectacular, over the next 6 to 12 months, it's just going to keep inching up. This is just money that households need to find, and it's money that households won't be spending on other things that contribute to the economy and contribute to more cyclical companies. So, it's been interesting, the trading updates we've seen in the last 6 monthly earnings season in New Zealand. We did see softness in retail, like the Warehouse, like in Kathmandu. So for us, that kind of more cyclical retail focused area, it probably gets worse at the margin before it gets better. So that's an area that we kind of look at and say, things could be tough. Thinking of the election specifically, looking at companies like the gentailers again, they marginally look more attractive, particularly if we get this national government coming in. One of the risks that has been hanging over that sector for quite some time is the Lake Onslow battery project. Initially it was going to cost $4 billion, then it got raised to $16 billion. We're not quite sure what it costs, but what it does is just dampens capital expenditure in that particular sector. It also scares away some investors, just having this large political risk overhang. So they'll look marginally more attractive following the election. Depending on the government, you could get a little bit more attraction in housing-related stocks. So you've got National reducing the bright line test. It's actually hard to say what that would do for property prices. On one hand, you could say you get a lot of selling because people have been waiting to sell their properties and now they get the opportunity to do so without paying a capital gains tax. But longer term, at the margin, National's policies will probably mean the property market is a little bit stronger. Rental properties look that little bit more attractive because you'll get interest rate deductibility again. So maybe for some of those more property related stocks, and that includes the likes of the residential retirement villages as well, and maybe they look marginally more attractive under a national government.
What other areas strike you as being likely to either see policies stripped back, which this government has put into place, which investors might see as holding back returns? And are there any areas that you see where there's actually interesting new policy that might benefit some types of listed companies?
Yeah, it's hard to say outside those specific sectors. Another tailwind for healthcare, again potentially under National, is the additional payments and support that will go to nurses. Labour shortages in that sector in particular have been really, really tough over the past 3 years. They've had to pay up a lot, these companies, to get labour in, and that has, at the margin, pinched the overall profits and gross margins that they can extract out of their businesses. So that's another interesting kind of development out of elections, is that healthcare sector.
Have either of you given any thought to what a significant change in climate change policy settings might mean for investability, willingness to stay in the country? I mean, I'm thinking particularly of if we do have a change of government, it does very much look as if we'll be very reliant on the emissions trading scheme producing a carbon price that drives behaviour rather than complementary measures. Such as the one which saw BlueScope's New Zealand Steel refinery effectively subsidised to put in an electric arc furnace. There's a whole lot of investment going into, or potential investment going into, electrification. How might that change? Does that concern you at all? Have you given that much thought?
I would say it's inevitable, as we've seen with the severe weather events, that we need to find a way to adapt and deal with climate change. What's important, in my view, is that the transition path that this takes, how able businesses are in terms of the settings, that they can plan ahead for it, because it might be negative in terms of the extra investment required, but it's required over the long term anyway. So it is really, to me, about how able they are to plan over the long term around this, that certainty.
So what are the most important things, though, for that certainty to be established? I mean, we're now in a situation, it seems to me, where a fragile bipartisanship or across the House has been lost, and we may be in a period now where climate change will become increasingly an investor's issue. What do we need to see from whoever the government is to make sure that it is investable?
Patrick, I wouldn't underestimate what actually companies are doing off their own bat without governments on this issue. So I'll talk about Contact Energy here. We talk about having a higher degree and 100% renewable energy, and governments talk about it a lot. But Contact just went out, raised capital, and we were very happy to have our investors support Contact's capital raise when they raised for their new geothermal projects to build kind of grid resilience. For me, actually, them as a company, as a private enterprise or publicly listed company, has actually done probably more than a lot of governments have done to actually increase our renewable energy percentage. So by building that baseload geothermal energy like they're doing at Tahara, and they'll do at a further site after, that is helping New Zealand be cleaner. On the private market side, Lodestone Energy.
solar farm.
Yes, I got mixed up between a steakhouse and a renewable energy provider there. My apologies. What they're doing with solar, there's a lot of capital that wants to get behind these solutions. And so capital markets are, in my view, doing a lot of the heavy lifting. And there's even some really interesting early stage stuff going on in New Zealand. There's companies looking at battery recycling, which is going to be one of our next challenges. We're rushing to buy all these Teslas and Nissan Leafs and all these battery-powered cars, but we actually don't have the infrastructure in place for the next problem in 10 years' time. We're solving one problem, moving from petrol-powered cars to batteries, but we've got to think about the future problems that we've also got to solve as well. So, don't underestimate the innovation that's going on within capital markets. And actually, one disappointing thing I'd have to say from both parties is actually the real lack of getting behind innovation. I think one of the issues with these 3-year election cycles is that sometimes people just can't see beyond their nose and actually get together some really long-term policies. So, maybe some tax credits around research and development, a top up to the Elevate Fund. To me, these would be all welcomed policies if you're truly going to try and find long-term solutions to problems and really to empower capital markets to try and find and help find solutions to these problems.
So you probably answered the question I was going to ask, which was, do you see anything out there which would actually make a difference in either of the parties' policies that might shift the dial on, not only on innovation, but just general economic dynamism and long-term problem with productivity? Does either side of the house at the moment seem to be dealing with that, do you think, Christina?
I feel, to be honest, they're fairly similar. They might have a bit at the margins differences in policies, but it's very hard to get any policies that are significantly different from where we're at now, just because there's that conservatism and reluctance for change.
Which are sort of bedded in with the MMP, but have you given any thought to what happens if National does fairly poorly and ACT does very well? Do we get a slightly more radical economic prescription out of that than would otherwise be the case? And if so, what might that look like?
I have to be honest and say, to me, when I go through kind of the policies, the interesting one for me is the introduction of a third party, whether they have New Zealand First, because we can sit here, speculate National Act. They do seem pretty well aligned. But you add New Zealand First to the picture as well, and we could have a completely different government altogether.
Right. I mean, just let me press you on that. Just from an investor's point of view, which would you rather have? A National Act combination which may do a few things which will rattle the cage, or a National Act New Zealand First coalition which will probably have the New Zealand First handbrake in place and therefore be more cautious?
Yeah, I'd prefer two parties, and the reason is I just think we're at the stage where we just need to get things done. So, the chat from National around Resource Management Act, we need to get better in New Zealand at infrastructure. Now, it's really tough when we kind of are a subscale country in many respects, right? We go to Europe and we're in awe of these infrastructure systems that they have over there, but the reality is we are a small country, and it is a really large, when we do these big infrastructure projects, it is a really significant investment and a really significant portion of our overall kind of GDP and tax take. So I do think two parties is probably better than three, because I do think we need to see some decisiveness. We need to see some action. We don't need to see 3, 6 or 9 years of kind of muddle through policy, because I had a colleague come back from China earlier this year, and he came back and he was a bit of a China bull. Sorry if I'm digressing a bit, Patrick, but he's a real China bull, and he just came back really downbeat, and he said, Chris, what's going on in China is actually looking structural. So that's why I say I want a really decisive government, because when I look forward, I say, China's roughly a third of our exports. There's been a massive tailwind for our economy over the past 2 decades, but their dependency ratios, the amount of people who are working to retired, is looking very much like Japan in the early 90s. So when I look at our government today, I'm thinking invest for the future, because we're not going to have this easy growth that we had out of China for the last 2 decades. That's not going to happen the next 2 decades. We want to see some good forward-looking, decisive policy, in my view.
Just maybe going back to QSBO, but also NZIER's own quarterly predictions, what are you seeing in terms of construction trends, not just housing construction, but also significant infrastructure? Because it does strike me that even if we don't want to spend the money, we are going to have more investment we have to make either in business as usual or climate resilient infrastructure. So there has to be significant economic opportunity and activity occurring in those areas.
You're absolutely right. Like, just from the strong period of population growth that we've had, we're already needing that catch up, not just for housing, as you say, but for infrastructure as well. But what's been the issue is that particularly over the COVID-19, but even prior to that, what we had was with the labour shortages, that was really hampering the degree to which construction activity can ramp up. Now we're starting to see that easing in labour shortages, so it does suggest that you can start to get a bit more of that construction ramping up happening, and we do expect that. Also, of course, on the other side of it, we've got that strong recovery in net migration with that population growth that will necessitate the need for more infrastructure, and so that will underpin construction demand over the longer term. But it does appear to be the case that with that supply, more of it is now able to come on board to meet that demand.
Yeah, it's interesting, isn't it? The sense I have, tell me if you think I'm wrong, is that while we're seeing a slowdown at the moment, interesting over the weekend that Ockham have pulled a big apartment development off the market in Auckland because they just aren't able to make the pre-sales. But they're saying we've never built as many apartments as this year ever before, and we look 18 months out and it looks fine. Are we in the trough for construction at the moment? Is there any reason to think that trough might be extended?
So you've seen with the higher interest rates, the impact in terms of dampening demand, that's gaining traction. So you're seeing, certainly looking at consent issuance, in the QSBO, the architect's measure of work in their own office and what that means for the pipeline of construction work. Certainly you're seeing that pipeline of construction work easing, but as you say, from very high levels. What we would expect is that over the longer term, with this migration-led population growth, that will start to underpin that recovery in construction as well. And so you can couch it as what's going to happen over the next 12 to 18 months, which is one of easing in construction demand from high levels. But then beyond that, we would expect that recovery underpinned by the population growth that we're having.
One thing that's really striking me is that in a sense we're saying, yes, there's probably going to be a change of government, not expressing a political view about that, but in some ways it's the course of interest rates that has as much impact on how investment circumstances look over the next sort of year or so. Are we at the top of the cycle? Where do you think we are at this point?
So I'll start first from what we're seeing. We believe Reserve Bank has done enough in terms of interest rates. The fact that, in terms of the time taken, the lag with which OCR increases transmit through to the broader economic activity, as Chris mentioned, a large part of that reflecting the proportion of households that are of mortgages that are on fixed term rates. So I always realize that's statistics from Reserve Bank that around half of mortgages are due for repricing over the coming 12 months. So what that means is that as these many households, as they reprice, come off historically low fixed term mortgage rates of 2 to 3%, 2 to 4%, onto something around 7% or higher, that's where you're going to see a lot of the significantly higher mortgage repayments crowd out other areas of spending. And that's when you get the traction of the higher interest rates coming through, transmitting through the broader economy. So with that, we're still yet to see that full impact of OCR increases today. We believe that it will be enough for inflation to return back to the target of 1 to 3% over the coming years.
Do you think, Chris?
Yeah, so I mean, I might just relate to it a little bit differently and talk about what I'm doing as an investor. And yeah, I mean, our view there is that we want to buy longer duration bonds. We want to lock in these better interest rates because we think that monetary policy is, as Christina's talked about, it's working. It is working. It is impacting. Exactly. Yeah. We sit here and sound shocked that the economy is slowing down. That's exactly what. When you increase interest rates, that is exactly what the Reserve Bank of New Zealand is trying to do. So, for us, bonds look pretty attractive at the moment as an investment because when we look forward and we look through the interest rate curve in New Zealand, we're pricing in really tight monetary policy for a number of years. And essentially, if you're buying and locking in longer term interest rates and bonds, you're essentially entering a wager with the market. You're saying to the market, well, I actually think you have too high interest rates priced in over the next few years. I think the Reserve Bank are going to have to lower them at some point as the effects of monetary policy are well and truly felt. You've heard from both of us today, that it's still making its way through. People often ask, how long does it take for monetary policy to do its work? Go ask ChatGPT and they'll find you some academic papers that say 2 months, and they'll find you some that say 2 years, 3 years, 5 years. The reality is we don't know, but we know that it hasn't fully made its way through just from what we're observing in the economy. So the key thing for me when I look at it, and my day job is equities versus bonds, very simply, I do a little bit more than that, is essentially saying it is bonds for now. But, as we get more of the slowdown in the economy priced in, there's going to be some really interesting buying opportunities within the New Zealand market. We've seen the New Zealand market take a massive breather. We were the best performing share market out of any developed nation you can find in the 2 decades to 2020. Over the past few years, we've had quite poor performance actually relative to the rest of the world. So a common question that I get from people is, geez, Chris, when's the New Zealand share market gonna really bump up and start performing again? My answer to that question is probably not yet, but the valuations are looking a lot more attractive in the New Zealand market. So I'll be looking for buying opportunities as this as we see kind of a lot of the slowdown kind of play out, and as bond yields come down, and maybe that means equities will look kind of more attractive in a relative sense. But 6% for cash at the moment, kind of a cash fund. You can buy most bond funds yielding you a little bit more than that. It looks pretty good to me.
The one thing that I haven't asked either of you about, which could be a bit of either a spanner in the works or the harbinger of a swifter recovery, is, again, assuming, and I'm sorry for listeners or viewers who still hold out hope for a Labour-led government, is the assumption that we will get the first significant bracket creep tax reform for 13 years. A whole lot of households are going to have a whole lot more cash coming in from about the 1st of July next year. Is that going to make inflation worse, or is it going to give us a cushion, do you think?
I would go back to the fiscal impulse that the budget within every budget is that if with the tax cuts, how you fund it. I guess there's been a lot of discussion on that. But net, what the government books are doing, is it adding to the economy in terms of the fiscal impulse, or is it subtracting? So yes, tax cuts in isolation would add to inflationary pressures, but if it's funded by taking spending from elsewhere or taxing in other areas, then that would be subtracting inflation pressures from the economy. So I would be more interested in the net impact on the economy in terms of where you get the offsetting changes, if any.
What's your best guess as to how that might look?
It really depends on how the government chooses to fund their spending and tax plans.
Yeah, it might be whether it's able to.
Yeah, look, I just think a lot of that stuff is just going to be at the margin, right? I don't think it's going to be a massive driver of kind of core inflation. I think what's going to be kind of more interesting is kind of the reaction that we see over the next 6 months of the next government around what house prices do. I mean, I'm a big believer in the wealth effect. So I think if we continue to see this recovery kind of in housing, you could get households feeling that little bit wealthier. Add to that tax cuts. Tax cuts, it kind of is tax cuts. You got the moving of the tax brackets. You could see a bit more activity in the economy, but I don't think it's going to be like a big driver of overall inflation. I think it'll just be something at the margin.
I think perhaps we already had the conversation about this, but I don't necessarily see much in what we're being offered by any of the major parties that would foster that early stage to become listed companies. Do you think that's fair, or is there stuff there which someone is proposing which I've missed?
I think National have proposed some visas for to give residency to people who are really highly skilled kind of technology people from offshore. So I think there's 250 or so visas to kind of get the skills over here to aid the earlier stage kind of companies in New Zealand. But that's probably a little bit at the margin. It's not a groundbreaking policy. It's not like anything I mentioned earlier around R&D subsidy or anything really major like that, which would really drive forward innovation. It's I suppose, a smaller kind of policy announcement.
I'm not aware of any policies either, but I also feel beyond the having the seed and planting the seeds of innovation, what we find is that also a lot of companies, once they've figured they've got something good, where they're striking that barrier is when it comes to scaling in New Zealand. It becomes a lot harder to scale up once they feel something is successful enough that they do want to make a good go of it. And that's where probably a lot of policies to help enable that stage to go through would be successful if we want to be growing that innovation ecosystem.
Look, thank you very much both for your time. We've only got a few more days now to wait before we actually know what the outcome is. Hope you've both voted, or at least decided when you're going to. Thank you, everybody who's tuned in today. You can watch Shared Lunch on YouTube or follow the podcast on Apple, Spotify, or wherever you get your podcasts. Leave us a 5-star rating and a comment with who and what you'd like to hear about in the future. To help you feel more informed about the lead-up to the election and the immediate aftermath, BusinessDesk is offering Sharesies investors free access to its business news service from now until the 30th of November. To start reading breaking news, analysis and commentary on a wide range of topics for free until the end of November, follow the link in our description. You need to be a new BusinessDesk subscriber and use the link provided to take up this offer. And if you do take up the offer, you will get a complimentary subscription to the Wall Street Journal as well. So what are you waiting for? Enjoy the rest of your week.